What I Learned Losing $1 Million Summary. What's the story of What I Learned Losing $1 Million? In What I Learned Losing $1 Million, 1994, the narrative unfolds the journey of a trader who ascends to the pinnacle of success only to face a series of unfortunate decisions that lead to a substantial financial loss. This captivating exploration delves into the intricate psychological and behavioral aspects of market trading, unraveling the perplexing question of why traders sometimes abandon reason, allowing losses to snowball into unmanageable proportions. The book not only elucidates strategies to evade losses, but also emphasizes the paramount importance of steering clear of financial pitfalls over the pursuit of wealth for those aspiring to triumph in the world of trading. Who's the author of What I Learned Losing $1 Million? Jim Paul, hailing from humble beginnings in Kentucky, embarked on a remarkable trajectory from a modest background to becoming a futures trader. However, his journey was marred by a significant setback, a $1 million loss resulting from an ill-fated investment decision. Despite this adversity, Paul demonstrated resilience and later secured a position as a vice president at Morgan Stanley. The co-author, Brendan Moynihan, currently serves as the managing director of Market Field Asset Management and holds the esteemed position of a finance professor at Vanderbilt University. Notably, Moynihan is also the author of Financial Origami: How the Wall Street Model Broke. Who's What I Learned Losing $1 Million Summary for anyone fascinated by the dynamics of entrepreneurship, money, and investments, and for those wishing to learn how to maximize their power to their greatest benefit. Why read What I Learned Losing $1 Million Summary? Ever wondered why bubbles burst and markets come crashing down? The echoes of the 2008 financial crash still resonate, leaving us grappling with this perplexing question. Few possess the insights to unravel this financial mystery quite like Jim Paul, a seasoned city trader whose meteoric rise turned into a descent to rock bottom, all due to a risky investment doubling down. They say pride precedes a fall, but the most profound lessons emerge when we muster the strength to rise again. Jim Paul's journey from the depths of financial despair back to the pinnacle began with a meticulous analysis of his past decisions, probing the psychological forces that had wielded influence over his choices. In this summary, we'll unravel the invaluable lessons Paul gleaned along his path of redemption. You'll learn why traders, even seasoned ones, find themselves making regrettable choices, discover the genuine key to navigating turbulent markets successfully, and gain insights on how to cultivate rational, not emotional, investment decisions. In this summary you'll learn why managing losses, rather than just chasing profits, is the cornerstone of triumph in the unpredictable world of trading. The pitfalls of following the crowd blindly, discovering why succumbing to collective sentiment can lead us astray in the complex landscape of financial markets. And how to differentiate between the reckless gamble of financial speculation and the measured, strategic approach that defines sound investment practices. By What I Learned Losing $1 Million on Amazon. What I Learned Losing $1 Million Lessons. 1. Cut your losses. Jim Paul, driven by an unyielding desire for financial success, ascended to the heights of prosperity, making an impressive $248,000 in a single day. However, his story takes a dramatic turn as he becomes ensnared in the perilous web of unbridled self-confidence, ultimately leading to the loss of everything he had amassed. Paul's journey began in the world of futures trading, where he quickly became a prominent figure on the Chicago Mercantile Exchange, renowned for his imposing stature and commanding presence. His focus on the soybean oil market seemed promising, fueled by low supplies and robust demand, setting the stage for anticipated price surges. With conviction bordering on arrogance, Paul exceeded the set limits on trading positions imposed by the Chicago Board of Trade, drawing in not just himself but also his clients, friends, and even his office assistant into his ambitious venture. As the market dynamics shifted, Paul's unyielding confidence became his downfall. Political instability, the looming threat of grain sanctions, and adverse weather conditions affecting bean crops led to a downturn in soybean prices. Despite mounting losses of $20,000 per day for months, Paul clung steadfast to his belief in an impending market reversal. His clients and fellow traders abandoned ship, recognizing the impending disaster, but Paul remained resolute. Blinded by his confidence and unable to discern the warning signs, he persisted in the face of overwhelming evidence to the contrary. The consequences were dire. His manager fired him, seizing his assets, and he had already incurred a staggering loss of $800,000, half of which was borrowed from friends. The question that lingers is, why did Paul persist in his decision when all signs pointed in the opposite direction? This exploration into the psychological intricacies of Paul's choices unveils not only the perils of unchecked confidence, but also the importance of adapting to changing circumstances in the volatile realm of financial markets. Moving on. 2. Don't lose money. In the pursuit of wealth, everyone seeks the golden ticket, the shortcut to financial success. Stroll into a bookstore, and you'll be bombarded with countless tips on how to amass riches. However, the challenge lies in discerning whom to trust amidst the myriad voices offering guidance. With conflicting advice from business gurus and successful investors, such as Ian Templeton advocating for diversification while Warren Buffett suggests concentration, the path to wealth becomes a perplexing maze. Yet, amidst the discordant recommendations, a universal nugget of wisdom emerges: the paramount importance of avoiding losses. Even in the diverse strategies of the most successful investors, a singular piece of advice resonates: don't lose money. Warren Buffett, with a net worth of $100 billion, staunchly adheres to this principle, emphasizing it as his first and foremost rule in investing. Other luminaries, like Bernard Baruch and Jim Rogers, echo the sentiment, urging the quick and clean acceptance of losses as a crucial skill. Amidst the wealth of conflicting strategies, what unites these financial giants is their ability to minimize losses. As Jim Paul sought to rebuild his financial empire, he recognized the pivotal lesson that understanding loss is the true pathway to enduring wealth. The questions that arose: how should one comprehend loss? What's the optimal way to process it? Most crucially, how can losses be avoided or, at the very least, minimized? In the following blinks, we'll delve into Jim Paul's revelations, exploring the profound insights he gained on understanding loss, processing it effectively, and implementing strategies to sidestep or mitigate its impact. The journey to lasting wealth, as Paul discovered, involves not just the pursuit of profits, but a deep understanding of the significance of managing losses along the way. Next. 3. Leave emotions out. Loss, a word that carries a weight of negativity, evoking memories of departed loved ones or even sour experiences like a lost ball game or bet. Interestingly, the psychological reaction to this term extends beyond personal realms and influences the behavior of market traders. However, the key lies in understanding that loss, in itself, is not inherently problematic. Consider a greengrocer who anticipates a small percentage of apples out of 100 turning rotten. It's a loss, acknowledged as an inevitable aspect of the business, accepted without excessive distress. Yet, the challenge arises when individuals take losses in the markets personally, attributing them to personal failure and struggling to control their emotional responses. The fear of making mistakes intensifies this emotional response. In the dynamic world of trading, emotions can cloud judgments and exacerbate situations. Take the soybean market as an example. Initial analysis predicts price increases, prompting an investment decision. However, when prices start to fall, emotions run high. The rational approach would be to cut losses, akin to the greengrocer discarding a rotten apple. But traders, being human, often succumb to emotional decisions, viewing losses as personal failures. This emotional entanglement leaves traders with a dilemma. They can acknowledge the mistake, admitting to a loss of $100,000, or they can double down on their initial decision, insisting the market will eventually align with their predictions. The difficulty lies in the inherent challenge of admitting mistakes, leading traders to ignore evidence and hope for a market shift that might never come. The danger in this emotional stance is apparent. What begins as an acceptable loss can swiftly escalate into a far more serious predicament. In exploring Jim Paul's journey, we'll delve into how understanding and managing this emotional response to losses became a crucial aspect of his strategy for navigating the unpredictable seas of the financial markets. Onwards. 4. Avoid common fallacies. Picture this: you're flipping a coin, and for 6 consecutive tosses, it lands on heads. Now, what's your instinct for the 7th toss? The logical fallacy might trick you into believing it's destined to be tails. This scenario exemplifies the type of common fallacies that often underpin our flawed analyses and lead to making mistakes and incurring losses. In the realm of pure logic, each coin toss is an independent event with a 50-50 chance of heads or tails. Yet, as humans, we tend to seek patterns where none truly exist. Traders frequently succumb to this tendency. For instance, if an investment in lumber takes a downturn day after day, rational analysis suggests reconsidering the investment. However, human psychology often whispers otherwise, encouraging the belief that if you hold on a bit longer, the market is bound to turn, a shift from rational assessment to a form of gambling. This form of irrationality is perilous, especially in continuous events. Unlike discrete events with a defined beginning and end, continuous events lack such boundaries. Imagine a horse race where you can place new bets after every 100 meters. The risk compounds as you can keep betting indefinitely, exposing you to the potential for accumulating ever larger losses. In the financial markets, there's no clear finish line, making it akin to a perpetual horse race. The human predisposition to make poor decisions in situations with unlimited opportunities to place new bets contributes to traders sometimes accumulating losses until they face a catastrophic wipeout. Jim Paul's journey sheds light on how understanding and avoiding these logical fallacies became a crucial aspect of his strategy, providing invaluable lessons for navigating the unpredictable and often treacherous terrain of financial markets. Next. 5. Break free from herd mentality. Have you ever observed soccer fans passionately yelling at referees and opposing players in the stands? It's a phenomenon unique to the stadium setting, where individuals feel powerful and uninhibited in the midst of a crowd. This sense of collective energy is contagious. We mimic each other's actions, finding affirmation in seeing our behaviors mirrored by others. However, the infectious nature of crowd behavior can be a double-edged sword, especially when fear becomes the motivating force. In the face of fear, particularly the fear of missing out on an opportunity or losing money, individuals are more prone to follow the crowd. Traders are acutely aware of this dynamic, recognizing that many of their worst decisions stem from succumbing to the mentality of the crowd. The 17th-century Dutch tulip mania serves as a classic illustration of the dangers of crowd behavior. Traders in the Netherlands became obsessed with tulips, driving the price of bulbs to astronomical heights. In a pure manifestation of crowd mentality, individuals bought tulips simply because everyone else was doing the same. However, the bubble eventually burst, resulting in widespread financial ruin as investors were wiped out. The analogy extends beyond physical crowds, it encompasses a state of mind. Every time individuals make impulsive decisions based on advice heard or articles read about the latest investment craze, they are, in essence, part of the crowd. Emotions often take control in the heat of the moment, mirroring the fervor of a cheering stadium during a soccer match. Understanding the influence of crowd behavior is crucial for traders, as it unveils the potential pitfalls of succumbing to the contagious sentiments of the market. In Jim Paul's journey, we explore how awareness of this phenomenon became a key component in navigating the complex and emotionally charged landscape of financial decision-making. Next. 6. Don't make mistakes. Morgan Stanley, the investment banking giant, experienced resounding success throughout the 1980s and 1990s, and their secret weapon can be summed up in one word: planning. Morgan Stanley was renowned for its meticulous attention to detail, incorporating both best and worst-case scenarios into their thorough planning process. While some criticized the firm for occasional delays due to this comprehensive approach, their traders held firm that this diligence was the reason they avoided mistakes. The rationale behind such meticulous planning is straightforward: a well-thought-out plan minimizes the likelihood of emotions hijacking the decision-making process later on. To prevent emotional decision-making, it is imperative to address significant questions before diving into investments. What types of investments align with your strategy, long-term or short-term? What rules will govern your decisions? Will you wait for predetermined targets before making trades, or will you adjust your portfolio based on external factors like weather forecasts? These questions should not merely reside in your mind, they need to be documented. Creating a mission statement on paper provides a reference point for re-evaluation if things go awry. However, a plan alone is insufficient. You also require a reliable source of information. Sound investment decisions stem from a clear-eyed analysis of the situation, not the hearsay of the crowd. Begin with the facts, grounded in recent stock volume figures or price-to-earnings ratios. Regardless of your chosen analytical approach, consistency in sticking to your sources is crucial to avoid the pitfalls of doubling down on a bad decision despite overwhelming evidence. As the renowned psychologist Edward de Bono wisely noted, a person will use his thinking to keep himself right. In the intricate world of investments, relying on facts rather than thoughts or emotions becomes paramount. In the subsequent blink, we'll explore the final building block of success in the realm of finance. Onwards. 7. Know how to exit before you enter. Entering the market can be exhilarating, akin to the thrill of a casino where the night is young, drinks are flowing, and luck might turn. However, the sage advice from those experienced in such situations is clear: the easiest way to lose money is failing to exit in time. Consider Bob, a trader who trusted his gut and invested in timber at $30 with the expectation that it would reach $50 by month end. When the market took a nosedive and timber plummeted to $20, Bob's initial optimism led him to think, "I'm in it for the long haul, I'll get my money back soon enough." Despite the market dropping further to $10 months later, Bob clung to hope, ultimately accepting a massive loss. Bob's mistake was evident: he incurred additional losses due to the absence of a fixed exit strategy. Markets, like a horse race without a finish line, demand that individuals turn this continuous event into a one-off by setting limits on acceptable losses and exiting once that threshold is reached. The key to sound investment lies in knowing how to cut losses and exit in a timely manner. Establishing an exit plan before entering the market is the surefire way to ensure decisions are not swayed by emotions, logical fallacies, or crowd behavior. The art of successful investment involves answering the crucial question: how much can you afford to lose? Once this number is determined, sticking to it becomes imperative. Planning the exit before entering the market provides a structured approach, guiding decisions based on reason rather than gut instincts or the whims of the crowd. In the intricate dance of financial markets, a well-thought-out exit strategy becomes an essential element in safeguarding one's investments. What I learned losing $1 million review. The key takeaway from these insights is clear: financial losses can quickly escalate when emotional decisions cloud rational thinking. The path to success involves meticulous, rational planning, and the ability to avoid and minimize losses. While there are numerous ways to accumulate wealth, those who have successfully built and retained their fortunes share a common trait: the skill of mitigating and preventing losses. Take a reflective moment to assess your financial decision-making process. Are your choices guided by a well-defined plan and set guidelines that can serve as reference points? Alternatively, do impulsive decisions or a tendency to follow the crowd influence your approach? Honest self-reflection is crucial. Recognizing how emotions can overpower logic in decision-making is the initial step toward making more informed and effective financial decisions. What I learned losing $1 million quotes. Jim Paul and Brendan Moynihan quotes: experience is the worst teacher. It gives the test before giving the lesson. Smart people learn from their mistakes, and wise people learn from somebody else's mistakes. A fool must now and then be right by chance. Personalizing successes sets people up for disastrous failure. Speculating is the application of intellectual examination and systematic analysis to the problem of the uncertain future. Man is extremely uncomfortable with uncertainty. Success can be built upon repeated failures when the failures aren't taken personally. There's nothing worse than two people who have the same position talking to each other about the position. Speculating, and this includes investing and trading, is the only human endeavor in which what feels good is the right thing to do. Even if the position is a net profit, the trader or investor can go through the 5 stages.